Hi, my name is Joe Davis, president of Stonebriar Wealth Management. Today, I'd like to begin a 3-video series to help you avoid getting mauled or panicked by a bear market. What I won't be doing is giving you investment recommendations to ride out a bear market. Instead, I want to arm you with the right tools, information, and perspective to be an all-star navigator during a volatile market. By the end of these videos, my goal is for you to feel that you are still on track with your investment plan, and most importantly, to help you thrive on the other side of this valley.
Stonebriar Wealth Management, advisors for your life.
The stock market now has officially logged its worst 4 months to start the year since 1939, with a nearly 16% drop in the S&P 500 index being the guidepost. The broader market is feeling even more pain. Some tech stocks are 60 to 70% off their 2021 highs, with e-commerce, fintech, and cloud software being hit the hardest. Even media giants Facebook and Netflix have felt the wrath. If it weren't for the relative strength of Apple and Microsoft, which make up 13% of the S&P 500, we would likely already have hit that ominous bear market definition of a 20% market decline. The NASDAQ 100 is currently sitting 25% off its all-time highs, for the sake of perspective. So what's causing all this volatility? Well, one could say momentum in stocks was ahead of itself and due for a pullback. Then throw in dramatic inflationary data combined with reactive policy adjustments by the Federal Reserve, and now you have a recipe for instability. And let's not forget that there is also a war being fought on the other side of the world with the Russia-Ukraine conflict, showing no signs of de-escalation. Although significant rebalancing may have been conducted in your portfolio over the past few months, at some point, there just isn't any room left to take more investment exposure off the table. Your long-term portfolio performance will assuredly suffer if you go all the way to cash. Additionally, there won't be any white flags at the exact bottom telling you the coast is clear and you can return to your former well-balanced strategy. The reality is your portfolios are likely to miss out on considerable capital appreciation once the momentum turns back to the upside. So without further ado, the following research and recommendations follow time-tested practices that will help you steer away from being mauled by the bear market. Let's start with some statistics. Number 1, stocks lose 36% on average in a bear market. By contrast, stocks gain 114% on average during a bull market. Number 2, bear markets are normal. There have been 26 bear markets in the S&P 500 index since 1928. There have also been 27 bull markets, and stocks have risen significantly over the long term. Number 3, bear markets tend to be short-lived. The average length of a bear market is 289 days, or about 9.6 months. Much shorter than the average length of a bull market, which is 991 days, or 2.7 years. Number 4, bear markets have been less frequent since World War II. Between 1928 and 1945, there were 12 bear markets, or one about every 1.4 years. Since 1945, there have been 14, one about every 5.4 years. Number 5, half of the S&P 500 index's strongest days in the last 20 years occurred during a bear market. Another 34% of the market's best days took place in the first 2 months of a bull market before it was clear a bull market had even begun. In other words, the best way to weather a downturn could be to stay invested versus trying to perfectly time the bottom. Number 6, a bear market doesn't necessarily indicate an economic recession. There have been 26 bear markets since 1929, but only 15 recessions during that time. So a bear market doesn't necessarily mean a recession is looming. Number 7, bear markets can be painful, but overall, markets are positive a majority of the time. Of the last 92 years of market history, bear markets have comprised only 20.6 of those years. Put another way, stocks have been on the rise 78% of the time. So the bottom line, folks, is bear markets typically bottom out when the news and sentiment appear to be the worst. It's also when investors get sucked into the mentality of selling at the low and ultimately missing out on the consequent growth in the aftermath. Think about it this way. The average bear market is a 36% drop from high to low over a span of 9 months. So if we are currently sitting somewhere between 18 to 20% off the highs on an average basis, and we are 4 months in, then you are roughly halfway through a typical cycle. It could be a little worse or better depending on how this event plays out, but ultimately we are already well through the large portion of the chaos. You probably agree that the current down cycle has not been overly devastating to impact your daily lifestyle. A subsequent recovery phase could allow you to recoup all of those losses and even emerge ahead of where your peers who succumb to impulsive behavior are. In other words, we may already be halfway there. Let's work through the second half together to effectively compound your wealth. And please stay tuned further for 2 more videos in my series, Don't Get Mauled by the Bear Market, looking at investor psychology and tips for survival. Thanks so much.
Stonebriar Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance. It is not a guarantee.